Assalamu alaikum friends, welcome to day 2 of AFM 14 days revision crash course for September 2022 to June 2023. You can watch all the videos under the playlist of AFM 14 days revision crash course. Okay, so under that playlist you will get all the 14 days video. The day 1 video you can watch. So in day 1 we discussed the format of the paper, what are the topics that you need to master, and the topic was role and the responsibility of the financial manager. So in day 2, we are going to go ahead and start with investment appraisal, which is section B of your AFM syllabus. All your net present value, IRR, MIRR, discounted payback period, all those things we are going to cover here. A major area, which definitely is going to come. Okay, and it's going to be a mix of calculation and discussion. So let's start. So here we are going to focus on past exam history, which we always do for all the videos, like the past paper pattern, exam focus, free cash flow, because investment appraisal has to do with your cash flows only. Okay, deals with cash flow, free cash flow, inflation, because inflation will affect your cash flow. Also, taxation will affect capital rationing, because it's an investment appraisal. You cannot go and invest on every project. There are some limitations to your finance, various resources, which is the meaning of capital rationing. IRR, internal rate of return, another way of calculating your, it's another investment appraisal technique other than net present value. Okay, but it has its limitations which you have to know. Because of those limitations of IRR, we came out with another term known as modified IRR, MIRR. The formula and everything is there in your formula sheet, but there are some formula that is there in Excel that you have to know, which will help you to do this faster. Okay, that is there in your Excel. Discounted payback period. Okay, this also has, everything is with cash flows here, whether it is IRR, MIRR, or discounted payback period or net present value. Everything deals with cash flow that you need to know. Duration, even duration also. Okay, so and finally financial reporting and investment appraisal. So let's start with the past exam. In the past exam, MIRR from September 18 to September December 2021 never asked. That does not mean it will never be asked. Okay, it would be asked for your time, so be prepared. Even IRR was not asked. Net present value, it is asked. If you see in question 1, it has been asked 3 times. Question 2 and 3, one time each. Okay, you have to be prepared for net present value. Okay, duration has been asked in the same year when net present value was asked in question number 1. Mostly MIRR, IRR and duration, if they ask, they are for less marks. They might be asked, they might not be asked. But net present value, be very careful. They are always asked, and when they are asked, they carry lots of marks. Lots of marks are carried. Okay. Exam focus. Net present value is a very commonly tested topic which you cannot skip. You cannot say, I don't know net present value calculation. You cannot say that. You have to. When you go to AFM, you have to know it. And often it is asked in section A. That does not mean it cannot be asked as a 25 marks question. Don't pay too much attention to which section it comes. Rather, pay attention that it will come, so I have to be prepared. Okay. The only difference is if it is asked in section A as a part of a report, you have to write a lot. Lots of calculations you can expect. If it's in section B, calculations are less. That is the only difference. Other than that, there are no difference. In an exam, explain briefly what you have done. See, when a net present value is asked as a question 1, in the first part, there might be other parts to that also, right? Part A, B, C, D. Next part, you have to explain what you have done. That means what you have done, basically, to get the net present value. All the steps you are discussing in writing. Okay. Mostly they will ask you that. Okay. You have to state that you have ignored a sunk cost will gain you marks. See, some cost in your net present value you ignored, right? You do not include every cost. All the relevant costs are there. Not every cost is there in your net present value calculation. Understand that. They might give you sunk cost. Sunk cost means cost that you have already incurred in the past. Let's say research cost. You have invested in research. It's known as sunk cost. You can never recover that cost. That is the meaning of sunk cost. It's gone. You have you have spent it, it's gone forever. You're not going to recover it back. It is it is the meaning of sunk cost. So sunk cost, whenever they give you like money spent on research, it's an example of sunk cost. Sometimes they will give you write it very specifically as a sunk cost. Sometimes they will say research cost, marketing cost, or things like that, but they are not relevant cost. You have to ignore it. They do not come in the cash flow table. Okay, you always ignore it. But if you ignore it, you have to write it also. Just ignoring will not give you marks. Maybe you will get 1 mark because you're not writing it in the calculation, but 1 mark you're going to lose because you're not writing it. So please write that sunk costs are ignored. Always state the obvious assumptions also. Even the assumptions are very obvious, you might be thinking, the examiner will definitely know it, otherwise why they would have given. No, you have to make them explain. Don't have this assumption or this attitude, or they will definitely understand. No, you have to make them understand. It's your exam, not their exam. You have to write it as you know everything. Whenever you go to the exam, don't think yourself as a student that I can make mistakes and I will pass it. No, think yourself as you are the owner of a company. You are that financial manager of this company. It's your business. You are explaining to another person who does not have any idea about it, about sunk cost, about anything. Try to explain everything in the simplest way. Don't use complex English, make it very difficult, sound very difficult, and things like that. Keep it very, very simple. Very, very, very simple. Okay, so that's how you're going to get marks. Obvious assumptions, always state your assumptions. Let's say there are three for your cost of debt, you have used one interest rate. Let's say cost of borrowing you have used, but they have given you various other, like risk free rate they have given you, or other interest rate also. You have to write it. Which interest rate are you taking for cost of debt? You can say you have used borrowing rate, interest borrowing rate. Write it. If you have inflated the tax, assuming that they are accurate, write it. These all are assumptions. You have to write. You are getting marks for those assumptions. The thing is, sometimes examiner are very kind enough. They specifically state for that, like as a requirement only they write. Please state your assumptions, 5 marks. Sometimes they don't write, but even if they don't mention, you have to state your assumptions. It's always good. You have to state your assumptions. It's good. Write it in the report. Always writing will give you marks only. The steps that you have done, it will never take away your marks. In AFM, I'm telling you. Okay. Then, when assessing a project, ignore all financing cash flow. What are the financing cash flow? In the bracket, I've included it. Interest rate, exclude. Do not include it. Interest, exclude. Loan repayment, exclude. Dividend, exclude. Interest tax relief, okay, include. Sorry, exclude. Exclude, ignore. If it's a loan repayment, never go and deduct it from your cash flow. If it's a dividend that you have paid to someone, never go and deduct it from cash flow. If it's an interest that you have to pay for the loan, never go and deduct it from cash flow. Why? Ask me this question, why? Because when you're calculating that cost of capital, those interest, those tax relief are already there in that cost of capital. They're already taken care of. They're already included there. So don't go and deduct it back from your cash flow. No, don't do that. How are you doing it? See, when you're taking tax relief, when you're finding cost of debt, what are you doing? You are deducting tax from your interest, right? Isn't it? So already you are showing the impact for cost of debt. When you're finding cost of debt, already you are showing the impact of that lower tax, like lower tax relief on that interest. So why to go and deduct tax again from your cash flow? I'm assuming that you are able to picture what I'm saying, visualize, understand, please. I'm not able to show it like this, but obviously when you're finding cost of debt itself only, we are showing the tax relief and all, right? You're calculating tax relief and all those things there. That's why you're deducting tax, one minus tax from your debt. That's what you're doing to find the cost of debt. And that's how you find WACC also. So already when you're finding WACC, impact of tax, impact of interest are there itself in that calculation of WACC. So that's why all financing type of cash flow, these are financing, dividend, loan repayment, interest charge, ignore it in your cash flow. Also the tax effect also of loan repayment and interest charge, those also exclude, do not include. As I told you, there has been taken into account when you are discounting. To find that discount, cost of capital is nothing but that discount only, discounting factor you are finding out just to discount your cash flows. There itself you are taking it into account. So do not take it two times by deducting it from your cash flow. Now coming to free cash flow. Free cash flows are those cash that is not retained. It is reinvested in the business. And how you can calculate it is, this is the method. Revenue minus cost minus investment. I repeat, revenue minus cost minus investment. Free cash flow means this cash flow is free. You can do anything with it. You don't have to pay. It's not obligatory that you have to pay to anyone. You have deducted all your cost because cost you anyway have to pay. Investment also you have to pay. Out of that, this is left over. It's free. These cash flows are free. That's why the term is free cash flow. Okay. And this free cash flows, you discount and you find net present value. Okay. They are then discounted. You then discount them and find the net present value. So what are you doing basically in that cash flow? All your revenue, sales or commission or any other types of revenue other than sales, add, those are your cash inflows, deduct all your costs because they are outflows, variable cost, fixed cost, that cost, this cost, all your investment, working capital, initial investment, deduct, and what is left over is your free cash flow. This you discount and find net present value. That's what you're doing. This is the process, right? And relevant cash flows include incremental cash flow. Please understand, in that cash flow, what is the meaning of relevant cash flow? Only those cash flows that will change because of the project, that will increase or decrease because of this project. That is incremental. That means because of this project only you are incurring that cash inflow or an outflow. Otherwise, you would not have incurred. That is the meaning of relevant. If it is changing directly because of the project, then it's a relevant cash flow. You have to include it. Let's say you are getting a commission only because of this project. You have to take it in the account. It's relevant. If this project was not there, you would not have earned that commission or paid that commission. Understood? But some costs, like let's say staff, you have staff, existing staff, you are now relocating them to this project. So the salary that you have to pay to this staff are not relevant. Why? You are just relocating them to this project. Even if this project are not there, you still have to pay a salary to those staff, no? They're your existing staff. You're not taking new staff because of this project. So the salary that you have to pay to the staff are not relevant. So understand relevant and irrelevant cash flow. That is a must, because in your AFM exam, if you are unlucky, if you are lucky, they might give you all relevant cash flow. But if you are unlucky and you are unluckily, like you didn't identify what is relevant, what is irrelevant, you included everything, thinking everything is relevant, you will lose marks. So don't be in a hurry. Please understand what is relevant and irrelevant. Sometimes if you are lucky, they will give you all relevant cash flows only. Nothing to worry. But sometimes they might give you both to confuse you. Relevant with irrelevant cash flow. So please only include relevant cash flows. Irrelevant, ignore, but write it. That is irrelevant. That's why you ignored it. You have to write like sunk cost. Uses of free cash flow. One uses net present value. It is a basis for evaluation using net present value technique. Second, free cash flow will tell you the company performance. Obviously, the higher you have, the better it is. And if it's growing, increasing from year to year, it's good, right? It shows it's a growing trend. To calculate the value of a firm, remember, not only in your net present value, even for your acquisition and merger, free cash flow is very useful. This is a technique that is used to value your company. So free cash flow can be used in many areas of your AFM syllabus. In valuing your share price also. In valuing your share price also, you need free cash flow. Also, it's a representation of cash flow available to all capital provider. How much of this cash will be available to your stakeholders? Your capital providers means your lenders, your shareholders. This free cash flow is a representation of that. Now we are coming to inflation. Inflation will have an impact on cash flow. That's why we are studying inflation. So inflation affects both future cash flow and also the discount rate. Okay. So this you have to take into account. Let's say they will say sales are inflating by 4%. Costs are inflating by 5%. Remember, everything inflates by different amount. They will give different amount. So you have to inflate by different amount. Sometimes they might say it inflates for first 2 years, later on it's the same. Sometimes it does not inflate after a certain point of time. So you have to see these things terms. Don't simply assume it will be inflated every year. Sometimes, let's say they say first 2 years inflation is 2%, next 2 years sale will inflate by 3%. It could be like that also. So see in the exam how it is given. And make sure you know how to inflate cash flow. There are two acceptable approaches to dealing with inflation. One is known as real method, one is known as nominal method. If it's a real method, means no inflation. If it's a nominal method, inflation. But whatever the result is, both will give you the same result. Problem is students often mix the two. But in your AFM, okay, they have never asked real method. Okay, they have always asked nominal method. That means inflation is always there, you always have to inflate. I've never seen a question where they have given inflation and you don't have to inflate, or where no inflation was there. I've never seen a question like that. But if they give you like that, I don't know. I don't think so. I would say nominal method is the method that is going to come. But know that there are two methods. At least know it. Whether real method comes or not is not an issue, but at least know that there are two methods. Real means no inflation. Nominal or money means inflation. Okay. So inflate your cash flow. This is the method. Why am I giving you this method? Because in the exam, okay, sometimes you have to inflate, but they do not give you the inflation, but they will give you the two discount rate. Sorry, they will give you the inflation, but they will give you one of the discount rate. But remember, if it's an inflation, you cannot discount your cash flow with the real discount rate. No, if it's an inflation, you should discount it with the money discount rate. It has to be money means nominal holding. So you need your nominal discount rate. Sometimes in the exam, what they give you is they will give you the inflation. They will give you the real discount rate. They will write it, don't worry. If you're confused, how will I know whether it's real or nominal? They will mention it. This is a real discount rate. They will mention it like that. Don't worry. Everything is very clear cut. You only have to know how to use it. Okay. So real. If they give you real and the inflation, remember that real discount rate, you cannot use it to discount your cash flow. You have to find the nominal. How do you find the nominal? This method, this is known as Fisher's equation and is given in your exam formula sheet. In your CB exam, computer-based examination, when you're doing it, you will get it there. You just have to go down on your left-hand side, click that help button. From there, I think exam formula or there it will take you to that formula sheet which is there for your exam. Please go and check it out before your exam. Go and make sure that you know all these things. Okay, how to find the formula sheet, where is the page, where are the formulas of Excel. You have to know where to find all those things before the exam. Familiarize yourself with all those things. It's not in the exam that you have to go and keep hunting where it is and waste time. So this is known as Fisher's equation. It is there. The equation is 1 plus I equal to 1 plus R into 1 plus H, where I stands for money rate. That is what we are finding out. I stands for nominal rate. I would use nominal rate, okay? R stands for real. See, RR. Very easy. R, real. So real. H stands for inflation. H stands for inflation. So inflation, they will give you real rate, they will give you nominal, you have to find out. Sometimes they will give you the nominal rate. Inflation also they will give you. So that time what you have to do, don't go and find out real discount rate. We don't need it. Use that discount rate, no, which is given I, the nominal discount rate. They still give you. Why? To confuse you. Sometimes students go and find the real discount rate using nominal and inflation and use the real discount rate. Never do that. High chances are there students often mix these two things. That's why I'm emphasizing more on this point. Otherwise, I would have gone to the next slide by now. Okay. So please, if inflation is nominal, inflation, nominal discount rate. If it's not there, find out through this method. 1 plus I into 1 plus R into 1 plus H. So 1 plus R into 1 plus H minus 1. Take that 1 to the other side and find the I. That's it. You have to find out. That's it. Simple as it. Very simple, isn't it? It's very simple. Don't make it complicated. Okay, so always check what discount rate is given to you. Is it real or nominal? That is very important. Inflation will be given to you. Sometimes what you have to do is they might give you real discount rate, they will give you a nominal discount rate also, but you have to inflate the cash flow. You don't know the inflation, you can find the inflation also through this method. So if you know two of this, one missing figure you can find out, that you know, right? So whenever you want to find inflation or money or real discount rate, use this formula, you will find out. Two things will be given, one you have to find out. Missing, it's like filling the blanks or the finding the missing figure. But two things will be given to you. Otherwise you cannot find the third thing. Okay. So now come to the taxation. Tax will have an impact on your cash flow because from your cash flow only you have to pay the tax. That's why you have to deduct tax from your cash flow. So there are three important tax effects. Number one, tax payment on operating profit. Number two, tax benefit from tax allowable depreciation. Number three, tax relief on interest payment on debt. Okay. Tax payment on operating profit. Operating profit means your taxable profit. It's very easy. Taxable profit, you know how to find out. Just find the tax on that. Halas, percentage. Apply percentage and deduct. Taxable, tax allowable depreciation is something that will be given to you. They will give you that this is the rate. This is the investment maybe on machinery. Let's say you have to find out. Sometimes in the final year, let's say a project is for 4 years, you might have a balancing allowance or a balancing charge. They might sell the project machinery, or they might have a balancing allowance or a charge. You have to find out. All these things I've explained in my lecture. You have to go in my lecture to find the detailed explanation. I'm not going to explain here how to find tax allowable depreciation. Okay, but you have to deduct it and add it back. Why deduct it? You have to deduct this to find taxable profit. Tax benefit means what? Taxable profit is reduced. If profit is reduced, means you have to pay no tax. That is the meaning of tax benefit, right? But later you add it on. Why? Why? It's a non-cash expense, no? It's like how depreciation you add back because it's a non-cash expense, you deduct it to find profit. Same way for cash. The main purpose why you're deducting tax benefit, tax allowable depreciation, is just to find taxable profit. Once you find the tax on that taxable profit, there is no job of taxable, add it back. Tax allowable depreciation for your cash flow. And normally start deducting your cash outflows. That's it. That's all you need to remember. Deduct, add, deduct, add. Tax relief on interest payment on debt. Okay, whenever you are paying an interest, a loan you are taking, you will be having a tax relief. That's why it's 1 minus tax for that debt, because tax relief. So this three you need to remember. And remember, tax relief on interest payment, you do not do anything. It is just only taken into account when you are adjusting the discount rate, cost of debt when you're finding out. All things I've explained in lecture, you have to find out how it is adjusted and all. Capital rationing. Capital rationing means you cannot invest in all the project that gives you positive net present value. Not possible. Let's say 5 projects are there. Is it possible you can invest in all the 5 projects because all are positive net present value? No, you have to decide. You have to rank them because you have insufficient fund. In practical world, it's not possible. You will be having insufficient fund. Funds are limited, right? So it is known as capital rationing. It's limited. So there are two types of capital rationing. For discussion part, you can write this, okay? One is known as hard capital rationing, one is known as soft capital rationing. Hard means external factor, soft means internal factor. Okay? Internal means something that company has imposed. Company might have limited. Maybe they might have their own policy that beyond this they will not invest. Hard means it is something beyond the company's control, outside. Maybe bank is not giving you that much of finance. Maybe they are not giving you that much of loan. So it is something imposed by the external. Okay. Now, how do you solve this? Methods for solving capital rationing problem is, understand there are two types. One is multi-period, that is more than 1 year. Second is single period. In AFM, we are focused on multi-period because single period is in financial management, it has been tested, but still know it. Okay, because it is an assumed knowledge. When you come to AFM, don't forget financial management's knowledge. It's good to know it. So multi-period means more than one period there's a shortage of fund. It could be anything, labor or money or anything. Here in AFM, you don't solve it. You are not allowed to solve it. Calculation will not be asked. You only have to set up equations. That is known as linear programming. That's it. You have to watch my lecture for linear programming on linear programming. Okay? For detailed explanation. I'm not going to explain. I told you this is a revision. So when you come to this revision, please watch my lecture first and then come to the revision. I'm assuming you know what is linear programming. I'm assuming you know all these things. Capital rationing. Then you are watching this video. Then it's very helpful. First time if you're watching, you might not understand also. What is this capital rationing? What is this linear programming I'm talking about? At least once you have to go through the lecture to understand what the meaning of this before coming to the revision series. Okay. Second, single period. Here in financial management, you know that we calculated what is known as profitability index. And then we allocated the funds in, we rank them, right? 1, 2, 3, 4 according. But here, AFM, they will not ask you this thing, don't worry. Just know it, just for your knowledge purpose, I'm giving you. It's like a revision. This is how, in case if single period is asked, profitability index is calculated. Net present value divided by investment. Net present value divided by investment. Whichever is giving the highest profitability index, you rank them 1. And which is giving you the lowest, that's the last. Okay. And another thing is, this can only be used if investments are divisible. You cannot say 2.5 project. It will be either 2 projects or 3 projects that you can take. So it is only for divisible project you can use profitability index. And no projects are mutually exclusive. Otherwise, use trial and error. You have to use trial and error. But in AFM, they will not ask you this thing. Okay. Focus more on the linear programming, multi-period capital rationing. IRR. This is where your net present value is equal to 0. It's like you have to find a discount rate where your net present value is 0. Okay. Here, this you can find through intra or extrapolation. Linear intra. Forget about interpolation and everything. What is the formula for IRR? Just focus on that. This is the formula. This is there in your formula sheet. Okay. It will be there. So the formula is like this. L. What does each stands for? Let me give you here. Wait. L stands for lower rate of interest. See, you need 2 interest rate. Without 2 interest rate, you cannot find IRR. And you need net present value also in both those interest rates. This is like a trial and error. I will tell you a simple method to do. Okay. Rather than doing so much like what interest rate to choose. See, first interest rate will always be given to you. One interest rate is always given to you. Based on that only, you will either get a positive net present value or a negative net present value. Correct? Second, you estimate. How? I will tell you. Simple method. Write it somewhere. If you are getting a positive net present value, your next will be next net interest rate should be higher. You understanding? If you are getting a positive net present value, your next this thing should be higher. Cost of capital, your discount rate should be higher than that. Let's say with 8% discount rate, you are getting a positive net present value. See, your aim should not be to get next positive net present value. You already got once positive. Your next one should be, you should get a negative net present value now. One positive, one negative net present value. Like that discount rate you have to find out. But you don't know. Make sure that it's lower, sorry, it's higher. It should be higher than 8%. Because higher the interest rate, lower the net present value. That's how it works. If you do not believe me, check out with your calculator. Take any 2 interest rate. Check interest rate with 10% and 20%. With 10%, you will get a higher net present value. With 20%, you might get a negative, or even if it's positive, it will be lower net present value than with the 10%. Check out with yourself. Higher cost of capital will give you lower net present value. Lower net cost of capital will give you higher net present value. They have opposite relationship. If you understand this, your work is very simple. Predicting becomes easier. So let's say with 8% you are getting a positive. Try with 10%. Not less than 8%. It should be higher than 8%. You can take the next one 9% or 10%. Just take anything randomly, it will work out. This interpolation, this formula will work out with any cost of capital. Trust me. So you don't have to do trial and error every time and waste time. 30%, 40%. What is next? What is higher than 8%? No. If you are getting a positive with 8, take higher. But if it's the other way around, let's say you are getting with 8%, you are getting a negative net present value. You have to reduce your cost of capital. You have to go less than 8% to get a positive net present value. That means 7%, 6%, 5%, 4%, anything you can use. I always say use 1% more or less. That's easier to work out. Let's say 8% is your cost of capital. You are getting a positive. If you want to get a negative, work out with 9%. So 8 and 9%. Or if you want to get a negative to positive, then work out less. 8% was cost of capital given to you, work out with 7. So 8 and 7 or 8 or 9. It's easier to work out like this. This is the simplest method you can use. Okay. You just have to, even if you're not getting a negative also, don't worry. 8 and 9, 8 and 7 will work. You just need one higher, one lower rate. That's it. You just need to know what direction you have to go, up or down. That's it. Whatever interest rate you choose, it will work out. Don't worry. Okay. So one lower, one will be given already. You just have to decide whether you have to choose a higher rate than that or lower rate than given to you. That's it. Based on your net present value, if it's positive or negative. Even if you're not getting negative, but objective is it should be lower than what you are getting if it's a positive. And if it's a negative, it should be higher than that. Okay. So lower and higher. And check out inside the fraction, inside the bracket, the bigger bracket, NL. NL divide by NL minus NH. So it's always the interest that you are getting lower divided by lower net present value minus higher net present value. Okay, this always NL on the top. So NL on the top, when you go down also, it starts with NL. This is how you memorize NL. If you do not want to memorize, don't worry. Formula sheet is there, but I'm just explaining you how it works. NL divide by NL minus NH. Okay, don't make it the other way around. You might think that other way if I do it, it might work out. Don't do it. Don't change the formula. Keep it as it is. NL, that means net present value at the lower rate of interest. Okay, NL. NL divide by NL minus NH. Keep it like that. You might get minus minus, so it might become positive in the denominator. It's okay. Into H minus L. Higher rate minus lower rate always. Let's say 12 and 5%. 12 minus 5, 7. Okay. And get your IRR. Get your IRR. Okay. Try this on your own, okay, with some figure. Coming to MIRR formula is also there. But MIRR, net present value, they already have a formula in the Excel. I will show you later when I do a question. But already in Excel, there's a formula. Okay, MIRR and net present value go hand in hand compared to IRR. This is what you need to know. Why? Because assumption of MIRR and assumption of net present value are same. The only difference is in IRR. What is it? MIRR assumes that cash surpluses are reinvested at the firm's current cost of capital. Net present value also assume the same, that your cash flow are reinvested at the current cost of capital. Only IRR assume that they are assumed at IRR, internal rate of return. The cash surpluses are invested at IRR, internal rate of return. That's why there are limitations. That's why we came up with modified IRR. Okay. See, whenever you have IRR, net present value, MIRR, and you have to take a decision which project, you will always see IRR will give you a different project. Let's say two projects are there, project A and B. You will see projects, IRR will give a different decision compared to net present value and MIRR. MIRR and net present value go hand in hand. So it's easier. So always choose a decision. If you ask me, choose a decision based on net present value. If it's there, whichever is giving you higher compared to IRR. Over IRR, choose net present value because that is superior. If MIRR and IRR is there, choose MIRR. Okay, that's how it goes. So net present value first, MIRR second, third is IRR. Okay. How do you calculate MIRR? This is the formula, it's there. Okay, present value of R, that means return phase, that means cash inflow. All your cash inflow. So let's say your project is for 4 years. Year 0 is your investment, okay? Year 0 you do not take from year 1 to 4. Down, PVI, that is present value of investment. That is when you are taking initial investment, year 0. So present value of that investment. Basically, it will be same as the investment only because in year 0, you know, discount factor is 1. So it will be same only, right? So present value of return phase, that is R, that means cash inflow divided by initial investment, to the power 1 divided by n. 1 divided by n means number of years. Let's say the project is for 4 years. So 4, 1 divided by 4 into 1 plus RE minus 1. That R is the cost of capital. Okay. You can check my calculations. I've done some questions when I did a lecture on MIRR. You have to check my MIRR lecture. All my AFM lecture, you can get it now. It's there on my playlist. If you want to get the slides, the PDF version, okay, what you have to do is go to my channel, Sabi Akhtar About section. When you go to my About section, where you check my details and all, right, go down, you will check AFM lecture. Click there, get all the AFM lectures. You can download all the AFM lecture. Okay. But if you want to watch my videos, playlist is there, AFM lecture. Now, MIR resolves the following normal problems with AR. See, you have to write also. The thing is, if it was calculation, I would have not wasted so much of time in all these things. Solving issues, problems, these, that. But you have to write also. They will ask you to write. Okay. Like, for example, they might ask how MIR solves issues of IRR, or what are the limitations, how MIRR is an advantage of IRR. That time you have to write this point. So MIRR eliminates the possibility of multiple rate of return. If you know IRR, there can be multiple IRR for one project. Why? Because we always assume cash after a cash outflow. Investment will always have cash inflow. That means one sign only. Negative, then positive, 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 positive. What if there is negative, positive, negative, positive, negative, 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 then positive, then negative? Sign keeps changing. Inflow, outflow, inflow, outflow. In this case, it's very difficult. Try on your own and see. Try it. Maybe in Excel you can do it and check. You will get multiple IRR for one project. So how will you decide a project if it's multiple IRR? So MIRR overcomes that issue. You will not have multiple MIRR. It will always have one MIRR, like net present value. So MIRR overcomes that issue. Second, addresses the reinvestment issue. The first point, MIRR assumes cash surpluses are reinvested at firm's cost of capital. Same for net present value also. That's why net present value, how do we find out? We discount the cash flows by the cost of capital, isn't it? MIRR also, so same assumption. Since MIRR is unique, it can be used to compare project, because one MIRR, no, it's easier to compare project whichever is giving you the highest MIRR. Correct? Now, discounted payback period and duration, these are other investment appraisal. See, more than one investment appraisal can come. It's not only net present value. We have IRR, MIRR, discounted payback period, and duration. Don't forget the other methods, okay? Discounted payback period measures the length of the time before you can recover those. But they are discounted. Cash flows are discounted, okay? That means to cover the initial investment. Duration. Duration, it measures the average time to recover the present value of the project if discounted at cost of capital. These are the definition. See, higher the duration, will you accept the project? Will you like when it's taking more time for you to recover the investment? No, right? You will always choose the shorter. So that's why higher the duration, more risky the project is. Because no one will like when it's more time for you to recover the investment. You will always want to recover your investment in the shortest period, shortest duration. So higher the duration, more risky the project. And shorter the duration, less risky the project. Okay. Remember, in CBE, computer-based examination, you can use to save time. 3 formulas are there inbuilt in your spreadsheet function. Make sure you know how to use it. Net present value, IRR, MIRR. All 3 are there. But you have to, before pressing, you have to press equal. Otherwise, you cannot perform the function. In Excel, you always have to write that equal sign, equal sum, equal range, equal, if any function you do, you have to use equal net present value, equal IRR, equal MIRR, then bracket, open bracket, perform the function, close the bracket, enter, you will get the result. But I will always tell you, since when you're practicing this in the practice platform, first time when you're doing, second time when you're doing, always do it manually, normal way how you're doing net present value in Excel. Then use the formula and check, are you getting the same answer or not? Just don't rely on the formula the first time. Otherwise, you will not know it's correct or not. Okay? If you are getting the same answer from both the methods until you are confident, okay, if you are getting same answer from both the methods, then only you can use the formula. Then you can be sure that you know. But you have to know both the methods. You have to see, are you getting the same answer from both the methods or not? First time when you're doing, first few times. For net present value, IRR and MIRR. Later on, you can just use the formula. Once you're confident enough that no, you can rely on your methods, formula. It's working perfectly for you. Because first few times it will not work for you. You will get different answers. Okay? That's what I'm telling you. I'm warning you before. Now, last part of this video, financial reporting and investment appraisal. Okay, so when you're evaluating capital projects, it is not only net present value. Yes, having high positive net present value. Yes, IRR, MIRR. Yes, duration less. Yes, except the project, but it will have an impact on shareholder value, and it will have an impact on these things also. Like what? Share price. Is your share price increasing? Because ultimately your investment should increase your share price. Then only shareholders will be happy. Then only you can say shareholders wealth are maximized. Second, gearing. You might have to perform gearing function, debt over equity or debt divided by debt plus equity. ROCE, return on capital investment, because you have to report this financial reporting, you have to do, right? So you have to see earnings per share. Make sure that you know the method formula for all these things. It is not there in your formula sheet. Gearing formula not there, ROCE not there, share price not there, earnings per share not there. You have to know it. Okay, it's an assumed knowledge from your financial reporting. So don't ask me. If you don't know, Google it and you will get it. Okay, nowadays Google is there. You can get things information very easily in seconds. So earnings per share, it is earnings divided by number of share. So you will get it. Okay. Sometimes you have to calculate this, or sometimes if they ask you what is the impact on share price, or they might ask you what is the impact on earnings per share, then only you have to calculate. Otherwise, it's not important. Now, so these are the areas for the consideration. Number one, remember, this can affect key ratios. Sometimes ratios also you have to calculate to show the impact. There are timing differences between cash flow and profit. Just because you are receiving having a profit does not mean you have that much of cash also. There are differences. Timing differences are there. And this can affect key ratios. Number one, dividend policy. If you are cutting, okay, a cut in a proposed dividend, you are cutting dividend, why? To show that you have that finance to invest in your investment. Okay, in terms of cash flow, it's good because you are saving money. You're not paying it as a dividend, rather you're investing in your investment. From the point of cash flow, is good, but profit is a negative signal to the market, and it will affect your return on capital employed. Okay, how it will affect your negative return on capital employed? Check, see, take any number for your investment, increase that investment, and see the impact on ROCE. Just imagine a number, okay, to show to for you to test how it affects ROCE negatively if you're not understanding this. Because I would say that is the best way to study rather than memorizing. It affects negatively, it affects positively. Otherwise, you will forget. You might change also. Sometimes you might write it affects in a positive way. If you try to memorize it, I never used to memorize. I would never even advise students to memorize. I always say test yourself with numbers. That is the best way. You will never forget. Okay. Share prices will fall. Share prices may fall. Third, gearing level. What about gearing level? See, gearing level, they are based on market values, because you need market value of equity, market value of debt. Okay, and the net present value of the proposed projects will be built into the calculation of the value of the equity. When you're finding the equity, that net present value is there in the calculation of equity. Remember, adjusted present value, you need base case net present value, that is fully equity. So that equity is taken when you're carrying gearing level. So because of the net present value, if that changes, gearing level will change. Understanding? Right issue. Research shows whatever the theory is, right issue is often unfavorable. Maybe in theory they might say it's good, but in practically it is unfavorable. unfavorable reactions are there towards right issue. It lowers the price also, right? More than you expect, prices are reduced. That means right issues are not favorable in the market. Okay, so these are some areas that you can talk about when you are told to discuss. Now, upcoming next is international investment appraisal. This is going to take investment appraisal further. All these techniques that you have studied, net present value, are applicable there also, but some additional things you might have to cover there, which are there in international investment appraisal, like currency risk, like risk, exchange risk. You have to change using currency rate, right? So that will be the next topic for day 3. Until then, thank you for watching, and please, 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 you can get all the slides from my about section from my channel Zabi Akhtar. You go about section, go to AFM 14-day revision crash course, click that, download all the 14-day slides, and do not forget to subscribe to my channel so that you get notified by my latest video. And if your friend or anyone wants help in AFM or any other subject, SBR, SBL, AAA, and they do not know whom to find, or they're doing self-study, last-minute study, please share them this video, or you can share them the link of my channel and tell them to subscribe to my channel so that they too will be helped. Thank you, and see you in the next video.